Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jerad Leigh.
And I'm the other co-host, Ben Rose.
Welcome back, sir.
Thank you. I can see you welcome me back with an ounce of trepidation. What on earth is he going to say?
No, it was good. It's because you were last time you did a bunch of podcasts on a boat since we've last seen you. This is our first time back-to-back studio podcasting together.
And I have missed it very much.
Yeah.
I'm very happy to.
This is your safe space.
It is my safe space for that sort of trapped set of thoughts that otherwise plague my brain and can't be vocalized. So yeah, mostly reinsurance thoughts.
Mostly, yeah. Just
even at the weekend.
Yeah, the cold sweat nightmares of reinsurance podcast thoughts.
I did have a friend recently who told me they had a nightmare in which they were trapped inside the cell of a spreadsheet and they were rolling over in the night to try and change column. True story.
I'm not sure if I'm more concerned that I knew it was a true story or the fact that we have a friend group who has Excel-based nightmares.
Yep.
Yeah.
Sums up quite a few things.
Yeah.
So what are we talking about today, Jerad?
Oh, I was trying to think if I was going to try to transition this in.
Okay.
I wasn't successful. Spoiler alert, unsuccessful transition. But we want to talk today about sort of ethics in underwriting, which is intentionally super broad as a subject.
Does it include ethics in AI, which is a common other topic?
I think we can touch on that for sure, especially as we look at, because you have the sort of origin of ethics in underwriting as we try to just the purpose of insurance as a product. And then from there you have the introduction of legislation that helps sort of guide things and force the hands of players to do things the right way. But as we move more into how companies leverage modern technology and AI, how does that also ensure we don't introduce biases and other things to... So intentionally broad, we'll probably make this multiple episodes over time, but where do you want to start with?
I want to start with what I was reading this morning.
Let's do that.
It's on my mind. It's just got to get out.
Break free from yourself, huh?
Exactly. Come on, thought. You can get out there to the world through the means of podcast. It's not even that far a journey. Into the microphone you go. Anyway, keeping it serious. I was reading this morning a very serious paper, actually, for Her Majesty's government, because it was published prior to His Majesty's government, which was basically a briefing on the implications of EU, I think, directives rather than regulations. This is interesting. There are differences between them all, my lawyer brain says, but a type of EU paperwork which demanded that insurers stopped using gender as a rating factor in the UK and in Europe. I wanted to talk about this a lot on this episode because it's really, really fascinating. Because there's not just a discrimination angle here. I think it was one of these really complex scenarios where everybody agreed with the discrimination kind of wrongness, to structure a sentence really poorly. What the challenge was that actually trying to eliminate gender discrimination from rating processes is, one, really, really hard, and two, not necessarily beneficial to the rating process, actuarial reserving, etc. At large. So I was reading, first of all, this briefing paper to the government as to what it would mean if they enacted it in UK law, but then secondly, reading the coverage from the time. This was around 2012 that they put this into law. And the Association of British Insurers expressed like deep concern about what it would do. They were like, yes, we completely agree. You know, you shouldn't be penalised based or helped, I guess, based on your gender when you go to buy insurance products. But also trying to enact this is going to be very fraught. And also it might actually mean that everybody ends up paying more in the aggregate and so on. Because I'll give you a couple of examples and then I will end this rapid monologue. Female drivers, especially younger female drivers, would pay a lot less for their car insurance because younger male drivers tended to have a lot more accidents. And the insurers were effectively being told, you can't offer different prices based on somebody's gender anymore, so therefore the price of insurance for younger female drivers was going to go up a lot. And then because you then had this ambiguity pool of female and male drivers, they potentially had to reserve more because they didn't really know, or they couldn't use that in the same way that they traditionally would. But equally, they then had to rely entirely on marketing to manage their portfolio, which again was controversial, right? It's like we want to charge everybody the same, but try and end up with a portfolio that has more females in it.
Yeah.
As this just flew through so many complicated issues into the air for the entire way you ran an insurance business. But there we are. I'll stop. I'll let you unpack some of
It's
that.
a really complex topic, and I think the way and this feels like one of those ones you're sort of like tiptoeing into, so please don't sue us at the Reinsurance podcast. But you have it where if we didn't have data for things, this sort of discrimination piece would be very valid. Be like, I don't know, but we should definitely charge them more because of insert whatever bias I might have. But if we're able to sort of look at data points and go, well, we have tens, if not hundreds of millions of data points, and for drivers who are under 20 years old, there is a statistically significant difference in the number and severity of accidents between men and women. In that case, I would hold the position that the underwriting team should be able to, in the same way, if you're a health insurer, you should be able to use someone's like BMI or weight as an indicator. It's like, well, if you're really healthy, your likelihood of having heart disease is just is statistically less than someone who's not and when you think about the objective of what we're trying to achieve as an insurance industry to collect sufficient premiums to then aggregate and pay across losses and things, like you're kind of like, and to your point, the challenge is if we take away some of those elements, what we're just introducing is everyone pay more. Everyone already hates how much they pay.
But also, again, this is the part of the reason I wanted to start with that very thorny one, which, by the way, the ultimate conclusion was you could discriminate based on age, but not on sex or any other protected characteristic, because age, although it wasn't something you could change, it was something that did change over time, interestingly. Sure. And there were not sufficient grounds for big enough biological differences that actually made a difference in any of the other categories, and therefore it was, I think rightly, eventually they were, get rid of this. But it does raise this overall question of, well, should we just all pay the same? They tried to bring it down to just behavioral issues, which I think makes sense. The way you behave influences what you pay. But one massive leap now to a different topic, I think, will help us answer this question of should people pay different amounts for insurance depending on their risk, which is jumping to your home territory, the United States, where right now, because of caps put in place by regulators, most massive insurers like State Farm are abandoning California. Insurers in Florida are going out of business, and people can't get insurance because due to generations of people building homes in places where they probably shouldn't have built homes and not having to pay very high insurance costs, are now faced with the prospect of not being able to get any insurance at all because people can't actually provide that insurance at the regulated maximum. So another big topic of ethics.
Well, and this is kind of touching on this point of, is insurance products, are they a right in many ways? And I think this is what the United States is trying to do. And I think you see insurance subsidies exist all over the world because there's this recognition that insurance existing sort of is a boost to economies and helps industry thrive and helps sort of risk takers sort of go out and create jobs and all manners of different things. But at the same time, if you leave it to just purely the invisible hand of insurance pricing, it still might not be affordable. And in certain places like California and Florida, as big examples, it's certainly the case where that home's going to come down every few years. And the maths of insurance would mean that your premium should equal the price of your home every 4 or 5 years, which is very obviously unsustainable for a lot of people. So they then introduce some regulation around capping that. But again, if the insurer can't make money, they can't stay in the state. And so it does add a lot of complexity around how much of a right to have access to insurance should people have.
It's created as well on this broader ethics topic, a kind of some really perverse incentives as well, right? These caps. So, for example, it's made it really feasible for people who want to live by the sea in Florida to just go and live there and build houses there because there's demand to live there, because there's no quantification of the risk at
Yeah.
the point of that decision that means that they would have second thoughts about doing so. It's also made parts of not the capping in this case, but in other areas, so like in New Orleans and all this sort of thing. It's some bits of land that are very cheap because they flood as whenever there's a hurricane. It meant that house builders have just gone in and built tons of areas very cheaply for people to go and live in without thinking about the consequences or the sustainability of those areas, and then leaving a lot of communities effectively stuck there with these houses that should never have really been built in those locations in the first place. So I think ethics of underwriting doesn't just go to the point of how should you price risk fairly. It goes right to the point of what risks should we be taking on in the first place, and how does the way that risk is priced in the market at large impact the risks that we take as society at large. The sort of elasticity of demand for insurance actually should be a part of the elasticity of demand for other things, like whether you take on a venture, whether you build a home, whether you decide to fly a rocket to the moon. You should take into account the risk and the extent to which you can transfer that risk.
Yeah.
But I think,
because what's the saying? Like, there's no bad risk, only bad price.
spot on, right? Yeah.
And I think you're right. There should be an element of how that gets considered, and the industry is always going to be there to help protect risk. But sort of transitioning slightly into the technology angle, I remember having a conversation. This was maybe 4 or 5 years ago when insurtech was just becoming a thing, and it was a ton of talk around telematics and real time data and stuff. And what you had was already this beginning conversation of, well, if you're a great driver, and they always frame it around the good risk. So you're a great driver, you have no accidents, you have this, or your home is way far from the, and the point that I'd raised at the time was, if we do that, and if we get it where that individual's premium is sufficiently low, right? So if your grandfather had never had an accident over 45, 50 years of driving, and then, but like the insurer knew how good of a risk they were, so he paid $3 a month or £3 a month for his insurance and essentially nothing into the pot. Would that then create a pool in which, if you were a moderate or higher risk, you could not afford insurance? Which, and there's a risk in that chasming of good and less good risks, because at some point you need the people who are good risks to still be paying in something to the greater pool. Otherwise, the aggregation of capital and protection doesn't begin to accrue sufficiently large. And then the more severe risks have to assume all the cost of the program. So ethically, that's an important one to try to unpack.
You fired off like many, many different thoughts in my head at the same time, which may be due to the fact that I've recently tried to reduce the amount of coffee I had and then had coffee before this episode. Anyway, one of them was this idea of risk pooling, I guess, which seems to be at the heart of this conversation. And not just how we pool the risk, but also when and who. So, for example, our traditional case studies we've been looking at here have mostly been the underwriter pick and chooses one at a time through price which risks to accept into their pool. But actually, we've also seen sometimes through distribution schemes. So, for example, buying health insurance for people who work at your company, you can buy a group scheme with medical history disregarded, for example, which is one way of pooling in a more even way potentially. And this sort of thing is taken into account. So you're not as a employment incentive, if you have a long-term condition or illness that would make it very expensive for you to get insurance by yourself, weirdly, you working for this employer means that you can get your insurance affordably, which also means ethically challenging. You're trapped with that insurer, that employer. Side point. But that's a very common way of pooling risk. We've also seen groups of people who felt underserved by the private insurance markets who've come together as a group so that they had the purchasing power collectively to then go to market as a group. Pooling can also happen on behalf of the government, where you have these markets of last resort, but then that sort of negates insurance altogether because you have effectively the state sitting there to pay the bill, which I think a lot of people are concerned at the moment will become the norm in bits of the US, for example, where the private market just says, sorry, no thanks.
Yeah.
So that question of how do we societally pool risk in an effective way that is fair or equitable is a really challenging thing for us to grapple with.
Well, you used an interesting word there, which is fair. And
which is also the name of a scheme in California.
It is.
For fire insurance,
Yeah.
if you can't get a hail insurance.
Yeah. But I think that begins to underlie much of this conversation around, like, what does that look like? And it kind of parallels in many ways to how people think about, like, tax and certain things. Like, what is fair? How do and so many people will interpret it slightly differently. And there's this lens of, well, if it's, and it's very easy to have it where, your insurance should be higher if it's a more expensive vehicle or a more expensive home. That makes sense. If your home is worth £3 million, like, it'll cost more to insure than a house is worth £300,000. Like, but if you begin to look at locations and other points of data that remove that a little bit, and that cost kind of balances out of the value of the insured item, if you will, then pricing and the elasticity around that, trying to get to a position of where everyone goes, that's fair, right, really adds a lot of complexity to it, right?
Yeah.
And I think if you look at, most of our conversations look at it from the lens of property casualty insurance, but I think this is even more poignant in a health space, right? What is fair, what people should be able to have access to is, in the UK, you have a governmental scheme with the NHS. In the US, you have mostly a private scheme. And access to doctors and the frequency and the ease in which you can get there and all of these things, whilst everyone, I think, should be able to have access to medical attention should they need it, the fairness around stuff begins to unpack and it begins to erode very quickly around, is it the more money you have, the better? Like, I don't know. It's ethics in this space is really hairy, which is why it's an interesting topic.
Definitely. And I think this leads us quite nicely in some ways via a long and circuitous route towards some of the AI ethics piece as well, because when rules started to come into place, when we see state intervention of various types that we've talked about already, whether that's subsidy, whether that's capping, whether it's can't use these rating factors, it leads the participants in the private market, both the buyers and the sellers, to try and find other ways of doing it. So on one hand, one thing that was really interesting to watch was a shift towards behavioral factors, because the sort of more, I've forgotten the word. There's a good word for this. Immutable characteristics.
Oh, yeah.
There we are. The immutable characteristics were a no-go area. So, what can you use instead? And I think accurately at the time, insurance companies were asking themselves, are our customers going to be happy with us asking invasive questions on a regular basis? For, how much alcohol did you have this week? Have you been smoking that much? Because these lifestyle factors that change all the time. Telematics. How was your driving? Over the course of this year, not just on a one-off test. That we don't even ask people to do a driving test. To figure out how badly or well you drive. And so that actually really gave a boom, I think, to the insurtech market. If you look at the timings, so when the laws came in, it was 2012 that they decided it was going to be law, and they enabled a 3-year transition period in the UK. So insurers had to be using other means of pricing by 2015, which just about segues with the start of consumer-focused insurtech in the UK really kicking off, where we start to see massive rise in telematics providers, wearables in the health space as well, because health was very similarly impacted to driving, because if you were a man, you were more likely to die sooner, and therefore you got your health insurance more cheaply than if you're a woman.
Life insurance.
They couldn't do that anymore, right? So then you get Vitality and everything else coming out with watches, and it's like, your health insurance will be cheaper if you do this much exercise per month. So actually, I think the ethics weirdly gave a massive boost to this technology in insurance kind of question, because before everybody was quite happy to just do these groupings manually. And then that's part one of the tech piece that leads us to AI. The other part is that we then had to start looking for other statistically significant cohorts within the data that we could infer, useful information from. So data quality again comes in a big way here, and the amount of data collected. But people would then start using things like occupation as a big indicator of how good a risk somebody was, rather than just some of the classic factors they'd been using before. And then accidentally, in doing so, would infer that potential policyholder's gender, for example, which they'd just been told they couldn't do. So how did they deal with the fact that there were some professions that were dominated by one gender or another versus others, and how could they prove they weren't doing that on purpose, etc. So if they're up all these kind of issues, and then you go into AI, where you've got these we call them black box because you can't see what's going on inside them, models that are just running and looking for correlations within vast data sets, who are pulling out and saying this person should get a cheaper price. And you're like, why? And you can't unpick a lot of the time whether there's actually, it's found a way to replicate
so that
gender that it's not allowed to, for example.
I was going to dive into this black box idea, and then you opened that door very nicely too. No, you opened the door, which I will walk elegantly through now. But how important do you think it is from this ethical perspective that it's clear how price is calculated and what factors drive it? And if the comparison I'm making then is to like something like a credit score, where we know kind of broadly the types of things that make your credit score better. If you've missed your last 2 bills, your credit score is going to be worse. And if you pay your bills on time, it will be better.
Yeah.
But it's not direct correlation. Like you could be paying your bills and not have done any new behavior, and your score might go up 4 or down 5 or whatever it might be. So there's this undulation that happens even though we know like the factors.
Yeah.
So where would you think about it from a risk perspective of saying your age is a factor, and we sort of, but as we get more and more data sources, what if we identify the fact that anyone who buys Starbucks more than 6 times a week has we've identified statistically significant information that says they are a greater risk here, that we just apply it to this thing.
Could be true.
It could be true.
That's not to pick on that brand before you try to sue us.
Yeah, exactly. Please don't sue us, Schultz.
I'm going to pause temporarily to cough, so Cordy's going to edit this out. Excuse me.
Team cough.
Oh, yeah, team coughing session. No, that's a really interesting question. So what it made me think of first, interestingly, is you said, to what extent should it be allowed to use a black box in your insurance industry within a given economy, which I've added, because I think it depends on how high the barriers to entry are for alternative suppliers to step into those markets to offer contradictory services. I think if you're dealing in a market where there's like one state insurer and it's the only place you can get insurance and it's very hard for any alternative to providers to emerge, then that's a really worrying danger sign, because then there's like no recourse, nowhere. Some people, for some reason that they don't even know and can't explain, just aren't getting insurance. Whereas I think if you had a situation where you had very easy flowing capital to ventures, low regulatory barriers to setting up companies and so on, it wouldn't take long before, in the UK, for example, a very entrepreneurial group of people set up a competing insurer that said, like, we've noticed that this group is underserved, and therefore we're going to serve people who have run into this issue, that for some reason, if you own this car and your surname begins with the letter R, you're not getting insurance, and therefore we set up a company just to serve people like you. Even in the UK, though, being fair, that is actually quite a hard thing to do. So I think even if you had a quite a fluid economy like that, you might struggle to rescue some of the people who suddenly find themselves having difficulty getting insurance for a reason they can't even explain.
Well, and it makes me think back a little bit to like some of the elements in a much more nefarious position, but like the Cambridge Analytica scandal. Like they were able to capture such a huge array of data points that they kind of go, we don't know why, but we think these people will swing their votes this way if we batter them with these types of ads. And and it was really damaging in a lot of it begins to look kind of similar, and to the point where, especially for an insurance product, which is very different, that the risk of something just being correlated, it's like, oh, just because my car is red and my name starts with an L, like, well, but 80% of people, it's like, but that is not based on any sort of behavioral component like that field, but versus people who are on the road at certain times, or the amount of caffeine, like something that's more behavioral. And this sort of back to your point about something being immutable, but almost having it where you create parameters within the black box that are like, but it cannot be these things that are sort of, in many ways, something like a name is an interesting one, because that's certainly mutable if you wanted just to change your name. But you have it where things that would have no bearing whatsoever.
Or you'd think they wouldn't, right?
Right.
Yeah.
But even then you could, because it's like something as superficial as like your favorite color. But I could easily see something be like, well, people who like that color tend to behave more erratically, right? It's so as we get, and I think this is more interesting now, because as we get more and more data, we create, more data every day than we've ever created, like in the world or something. It's the amount of data we're generating now and is astronomical. And as insurers have more powerful tools and are able to build models that take in huge swaths of that and begin to, at least at first, just sort of go, are there trends here? Just bring the data in and just see what stories begin to pop out of it, as they try to pursue a better, more accurate model. What kind of framework should we be putting around that? And does this become a thing that the regulators have to step in and sort of drive?
I think it's a really interesting question, because again, going back to that thought, should everyone just pay the same? That creates obviously really horrible incentives and so on. It means you can do whatever you want. It doesn't matter. Your insurance will always be the same. So live fast and loose. But there are some things which across, I'll start with most, and I might rein back from that. Most lines of business you can pick on which are relatively consistent or reliable to each policyholder you're looking at. And I would say that's the reverse engineered, non-existent cost of goods sold that we have in insurance, right? So whilst probability is very, very hard to judge, severity is typically known at the point of purchase, except for inflation and all these other things, right? It's like the thing you're trying to insure against. If you're driving a Ferrari, it's going to be presumably a lot more expensive to get you a new Ferrari than...
And even on the casualty side, a lot of times there'll be a cap. Like your casualty limit is this. So even if you driving your Ferrari you only have 500,000 in limit for your casualty exposure. So
that's
that
really interesting.
You.
Okay, now you've successfully contradicted my point there. No, because if you think about it, casualty insurances that involve a community, again, you have a tragedy of the commons style effect here, where if you drive like an idiot and you kill somebody else, that was your behavior within a pool. Rather than something that was known before, and it's obviously much more expensive than the cost of the car as well. Maybe for pure property, then we can say, if your house is more expensive, you should pay more for insurance because it's going to cost more to rebuild. If your business equipment, etc., that gives you something quite tangible to hang off. But liability, if it's like the way you potentially cause harm to other people, that's quite an interesting, especially driver behavior type thing. Health is again a very.
I think it's the biggest driver of motor insurance premium is the concern around casualty risk. Right. Completely. Like a teenager driving fast and a bit reckless. There's less concern about them totaling that car, and there's less concern about them hitting a lamppost or a fire hydrant or something and causing some other property damage. I think the real concern the insurers have is they might cause us tens of millions in damage. Because they careened into this thing and took out all these people, and people are paralyzed or killed or whatever that. I think that's where the real concern comes in around that behavior risk.
Completely, that's definitely one we should put in there to discuss in future episodes with an expert. Unknown risk, like how do you juggle that one? The one part that, just looking for things that might be a bit easier to nail down, would be that exposure risk for natural perils. I guess that seems like there's a bit of ethics we haven't talked about in detail here as well. To what extent do people get to choose where they live and what natural perils they're exposed to, right? Because people in especially some developing regions are being exposed heavily to the climate impacts of those in other countries that are causing their regions to have more wildfires, to flood more frequently, etc. So it's not necessarily, going back actually to my earlier comment, it depends on to what extent you have a free market surrounding this that means people can choose to live wherever they want, etc. If you find yourself in a position where it's like, well, you chose to live on a floodplain, or you were that keen to live on the coast in Florida because you really wanted to live there and you were willing to take on the costs, and you could choose to move somewhere else, theoretically we could look at that and say, therefore it's fine. But if you can't really choose and you're stuck there, and that's where you've been given housing, or the idea of migrating is impossible.
Well, and I think that one is, and you see it a lot in the political spectrum of like, well, if you don't like the way that we enforce this law, just move somewhere else. It's like, that's not really how this works, though.
Exactly,
right? So I think, again, it's one of those things that in theory, sure, but actually you begin to unpack it, it has loads of additional elements to it that layer on the nuance and the complexity, and in many ways sometimes like the injustice of going, well, for some people, and weirdly those who are the most capable and most fortunate would be the ones who'd be most easily able to move somewhere else or transfer and be like, well, I'm just going to pick up and go. Like, so it's reinforcing this sort of regressive tax in some ways for those who are least able to change the situation, are then most penalized by being trapped in an environment, in which case they're incurring the burden of these additional premiums in this insurance example.
Indeed. And I guess actually, interestingly, if that were taken into account in property values for the property case, which is not because property is capped in Florida, for example, for the insurance, then maybe that would start towards the right people paying the right contributions. But I've been told time's up already on this one, but we're going to certainly have a part two, if not more. This is because this is a meaty one. Yeah, so tune in for more caffeinated live streams of our brains. You might want to put this on 0.8 times speed.
But no, that was super interesting, and we'll lean more into this one. And if people have questions or points they want to raise, I think this is another one we should sort of crowdsource components of this from things. So
people who know far more than we do.
Yeah. So reach out to us on the social medias, as they say. But until next time, thanks everybody.
Yeah, thanks again.